Do want to welcome in our next guest, though. Take a broader look at the markets. Joining us now, Tim Nyland, CFA and Co-Chief Investment Officer at Synergy Asset Management. Tim, it's great to have you on the show. Now, you say we've got three forces driving the markets right now: earnings, AI capex, and geopolitics. Now, I'm saying all-time high, another record high again this morning. How are we ignoring geopolitical risk right now? Because it certainly does feel that day on many days.
No, it's a great question. Great question. Basically, what's going on is we've got companies reporting just rock solid earnings. Q1 earnings season, we're more than halfway through. We've got close to 15% earnings growth year over year for Q1. And we've got that on top of roughly, 10% revenue growth. So basically what corporations are doing with these record earnings is they're riding that right into guidance. And guidance is extremely positive. Some companies are, obviously making note of the geopolitical headwinds, but right now it's really the corporate earnings season and capex spending that's really trumping what's going on with the geopolitical environment.
So with all that said, and the three forces that you pointed out, are we really in a fundamentals-driven market, or are we in this liquidity and narrative-driven market that's sort of being disguised as one?
It might be a little bit of both, because we've obviously got a ton of momentum, but believe it or not, if you look at just the S&P 500 in aggregate, the earnings growth is there, and so is the margin growth. So the valuations are justified from that perspective. Interestingly enough, though, if you strip out the top 10 names from the S&P 500 and you start looking at margins, you could argue that those are flat to perhaps even down since 2022. So there's an argument to be made both ways. But for now, if you're looking at the S&P 500 in aggregate, valuations are justified. That margin expansion is there, and the underlying earnings growth is certainly there for now.
And I'd love to get your reaction to some of the market response we've seen to some of these earnings. I mean, we've gotten incredible reports from companies that have been met with these downward moves. I mean, Palantir, there's an argument to say Palantir had an excellent report yesterday, and we're seeing Palantir under pressure today. A couple small flags in there that analysts are citing. But what has been your thought about the reaction to the numbers that we've seen?
They can be volatile, right? That's a pendulum that swings both ways. And if the street doesn't like something, the investors don't like one metric that they're keyed in on, those names can be taken to the woodshed, and we've seen it. We saw it with Meta. We saw it with the capex spend. Certain companies react one way, and other companies going to react another way. So that's kind of where we're at in the cycle right now. We've got valuations are obviously high, but justified. But that's a result. That's what happens.
All right, so let's talk about that cycle and capex spending on AI, because that's your third force driving the market. And I don't know anyone that's going to make an argument against that not being a primary driver right now. Is this capex cycle, yes, it's AI, but is it fundamentally different from what we have seen in past tech investment booms? Or are we just setting up for another digestion period here? I mean, what makes this one unique compared to the past?
This one is unique because it probably has a lot longer runway than most people think. And you can see that. I mentioned earlier about, the margin on the remaining 490 companies in the S&P 500. The fact that AI still has such a long way to be integrated in the remaining 490 companies in the S&P 500 means that we've got just a tremendous runway. And I think if you look at where the smart money is, right, you're looking at the corporate boards of the hyperscalers, they're not going to commit this type of capex without having some sort of an ROI on the back end. So they certainly see the demand, they're experiencing the demand, and that's what we're responding to as investors.
And I'm glad you brought up the ROI, because we keep talking about how this earnings period is when we really need to start seeing some return on these investments. And I think we're at $800 billion in hyperscaler capex now. I mean, these numbers almost feel made up. They're so astronomical. But in terms of what kind of returns you need to see to justify the spend, where are we at going forward? Because I know a lot of the responses were in that the markets thought they got enough return from some names and not from others, or we couldn't justify the spend, particularly when it came to Meta. But what are you looking for specifically when you're looking at these, knowing how long the runway is? How much return can you realistically expect, knowing how early we are in terms of the full scope of this AI build out?
It's a little bit different for each company. I mean, we have models on a lot of the different companies. They're all a little bit different. And that's what really everybody's trying to pin down. And that's why you're seeing these volatile valuation swings. Most notably companies like Oracle, Meta, and that's really what's driving it. Is there is an unknown out there. Every company is going to be different. Every company's ROI on this investment is going to be different. And the structure of all the deals are different. The manner in which, data centers are being financed. And so there's a lot to sift through for each and every company.
And you pointed out a really interesting thing that I think is very important to talk about in your notes that you sent over, that roughly 75% of our GDP growth has been tied to these AI-related investments. Now, at what point might we see a pullback in AI spend, because we are in this point where investors are demanding so much return and they want to see a return on the spend, which means we may start to see it slow down a bit to try to get some of that return. When does it start breaking? Should we be concerned that it's too concentrated and then could negatively impact our GDP?
Well, it's actually a really good question, and I think investors can really boil it down to, and your audience can boil it down to the simple fact that, if the corporate boards and if management of these hyperscaler companies feel as though those growth rates or that return on investment is going to begin to taper in any way, they will begin to cut back, and we just haven't seen that in a broad term. As of yet. So that's really what you have to look for, is you have to look for that growth taper. And then once that happens, you'll start to see multiples start to contract on that anticipated deceleration in growth. But right now, when you see acceleration in capex spend, like we've seen in Q1, obviously these corporations are seeing growth accelerating and the demand. And you can see it in the backlog as well. The backlog is growing as well.
And I want to talk about the third driver that you pointed out here with the geopolitical risks. And you laid out a really detailed stage-by-stage description of how you view this going. And I'm going to just walk through, because stage one was an energy supply shock. We saw that with the Strait of Hormuz closure. Stage two, broader inflationary pressures. We've gotten some evidence of that here. Your stage three is demand destruction. And I want to know if you think we're here, and what's signaling to you that we're here, and what comes next?
I think that we've just entered stage three. And we saw our first evidence of that by the release from the Bureau of Economic Analysis last week, when they put out the personal spending numbers. And within that report, you could actually see that that consumers were actually beginning to pull back on larger ticket items that showed, the highest cost increase. And that wasn't evident from the headline number, because the headline number was strong.
Well, really appreciate you being with us, Tim. Sadly, we're run out of time there, but really appreciate the insight there. And thank you for walking us through the forces you think are driving the markets right now. Tim Nyland, Synergy Asset Management.